Good morning, everyone, and my sincere thanks for the invitation to speak at this important event. It's great to have the opportunity to address the topic of conduct regulation in the insurance context, and I hope that the perspectives I bring today from my role at ASIC and at the Market Conduct Working Group at the IAIS will be helpful and relevant. I know that some of you will know my chair at ASIC, James Shipton, and he asked me to convey his apologies for not being able to attend this important event, and he sends his best wishes. And it's great again to see my colleague at the IAIS, Stephen Poe, your Executive Director for Market Conduct, as well as the IAIS Secretary General, Jonathan Dixon. So a common theme emerging from the recent round of regulatory and government reviews in Australia is that there has been too much focus by financial service providers on managing financial risk at the expense of conduct risk or non-financial risk. So today I'm going to start by approaching conduct regulation through the international lens of the IAIS and some of the important work that we've been doing to raise the bar of insurers' conduct across jurisdictions. I'm then going to talk a bit about the Australian context for insurance conduct regulation, a context which has seen a number of high-profile developments recently, and with more to come. As you've heard this morning from Jonathan Dixon, the IAIS has members from around the world, and it helps to develop and assist in the implementation of principles, standards, and other supporting material for the supervision of the insurance sector. The Market Conduct Working Group is one of several working groups that sit within the Policy Development Committee of the IAIS. It is responsible for the conduct of business agenda of the IAIS, which is currently a key priority. The working group has members from a range of different jurisdictions, as diverse as the Netherlands, Hong Kong, UK, USA, South Africa, Korea, and Canada, and from markets with many different characteristics. Likewise, the working group brings together regulators with a variety of roles and responsibilities. For example, Twin Peaks versus integrated regulators, sector-specific versus multi-sector. Some have competition and/or pricing mandates, and others do not. Some have rulemaking powers and regulate conduct, while others only regulate conduct. So a key role of the working group is to share experiences and to draw on those experiences to develop good practice. For despite some differences in regulatory roles and markets, there is much common ground across jurisdictions, and themes encountered across the world include failures to treat consumers fairly, including mis-selling, the drivers of such failures, including poorly designed or poorly targeted products that are not sold to those for whom they are suitable, and importantly, the impact of technology on insurers and intermediaries. The common themes that I've just mentioned have fed into the recent priority work of the Market Conduct Working Group. Two key conduct standards, called Insurance Core Principles, or ICPs, were updated and strengthened from November 2017. ICPs provide globally accepted standards for the supervision of the insurance sector. They prescribe the essential elements that must be present in the supervisory regime in order to promote a financially sound insurance sector and provide an adequate level of policyholder protection. ICP 18 on intermediaries seeks to ensure that insurance supervisors set and enforce requirements for insurance intermediaries so that they conduct their business in a professional and transparent manner. This includes intermediaries who act on behalf of the insurer, such as agents, as well as those that act on behalf of the customer, such as brokers. ICP 19 on conduct of business sets conduct expectations across the value chain and product lifecycle, prescribing fair treatment of customers from before the contract is entered into until all of its obligations are satisfied. The expectation is that product development, marketing, and sales are appropriately tailored and targeted to different customers' actual needs and wants, that clear and accurate information is provided to customers, that high-quality advice is given, and that customer complaints are treated in a fair and timely manner. The Market Conduct Working Group has currently prioritised work on digitalisation, artificial intelligence, and big data. These trends affect all members, even if different markets are at different stages of development. The working group has delivered an issues paper on digitalisation in insurance, and we have commenced work on an issues paper on the use of data in insurance. I will now move on to illustrate some insurer conduct issues in the specific context of the market and regulatory environment in Australia and ASIC's particular areas of work in insurance. After the financial crisis and the losses suffered by consumers during that time, there's been increased interest and concern in Australia, as elsewhere, in instances of misconduct in the financial services industry generally. The insurance industry has not escaped this interest and concern. My organisation, ASIC, has taken action in response to misconduct by insurers and intermediaries, as well as undertaken thematic reviews of the insurance industry, which has exposed problems, while not always illegal, have been clearly contrary to consumers' interests. The issues identified by ASIC as the conduct regulator, as well as in the media, have led to a number of inquiries, including separate inquiries into general insurance and life insurance. This year in Australia, a Royal Commission has seen further public scrutiny of the insurance and banking industry, again, not only by exposing conduct that may be illegal, but also by exposing conduct that falls below community expectations. For those who may not know, a Royal Commission is a major public inquiry with significant investigatory powers similar to a court. Announced in December 2017, the Royal Commission has had 68 days of public hearings with 134 witnesses, 400 witness statements, and hundreds of thousands of documents have been reviewed. The Royal Commission is due to release its final report and recommendations to the government in February 2019. This follows an interim report that was issued at the end of September this year. ASIC has acknowledged the trust deficit facing the financial services sector and the need for both industry and regulators to take action. As a starting point to establish trust, individuals, firms, and industry need to improve their conduct. And to support better conduct, cultural change and better governance are also vital. Which brings me to our updated vision and mission at ASIC. ASIC sees its role to achieve a fair, strong and efficient financial system for all Australians. As the conduct regulator, ASIC plays an important role in driving the behaviours that will build and restore trust. Our current strategic approach to regulation focuses on proactively identifying harms to consumers, investors and markets, prioritising and addressing the most significant harms, accelerating enforcement outcomes, implementing new supervisory approaches, and promoting the adoption of regulatory technology or RegTech by industry. ASIC's recent and ongoing work in insurance illustrates the importance of the recently strengthened ICPs. This slide shows a few areas where we have been doing a lot of work to improve consumer outcomes in insurance. Some of these areas involve the mis-selling of insurance products that offer little to no value to consumers. I will briefly describe our work with intermediaries and also discuss some of our work on Addon Insurance products. Starting with intermediaries, ASIC's work in the area of insurance intermediaries and financial advisors is focused on increasing professionalism and addressing conflicts of interest. Too often in the past, we have seen that these two factors can have a significant impact on consumer outcomes. The industry is facing some significant changes to the training and ethical standards of individuals and how the industry is remunerated for the sale of life insurance products. ASIC will be continuing to support these changes as they are phased in over the next few years. ASIC is supportive of these reforms and we expect to see a real impact on consumer outcomes as a result. A recent significant area of focus for ASIC has also been in relation to the sale of Addon Insurance products through the car dealership channel. These products cover risks relating to the car itself, such as extended warranties and tyre and rim insurance, or to the consumer's liability under a loan used to finance the purchase of the car, such as guaranteed asset protection or GAP insurance, and different types of consumer credit insurance or payment protection insurance. ASIC has identified several failures in this market, including poor value products. We found a very low average claims ratio for these products of 9%. Poor product design. For example, we found products where the maximum payout under the policy was less than the insurance premium. And excessive sales commissions. We found that car dealers were receiving, in aggregate, 4 times more in commissions than consumers received in claims payouts, with commissions paid to car dealers as high as 79% of the premium paid by consumers. More generally, we found that the add-on insurance market was characterized by reverse competition, where insurers compete on the price paid to car dealers in commissions to buy access to distribution channels rather than competing for consumer-driven demand. This reverse competition increases the costs to consumers and also increases the risk of mis-selling. ASIC has recommended that these problems be addressed through a combination of reforms and regulatory action, including the introduction of a deferred sales model, which would involve inserting a pause in the sales process to assist consumers in making an informed decision about whether to purchase the insurance, rather than bundling the insurance sale into the sale of the car, and also requiring that insurers improve their supervision of sales representatives and intermediaries that sell these add-on insurance products. While we have been consulting on the above steps, ASIC has also taken other action to improve consumer outcomes in this area. Importantly, we have negotiated refunds of over $120 million to over 210,000 customers with 4 large insurers and a warranty provider. Secondly, we have persuaded insurers to improve the value of their add-on insurance products by reducing premiums. Most insurers have cut commissions to around 20%, resulting in significant price reductions for consumers, and also improving their products. Several insurers have reviewed their offerings, leading to either product redesign or withdrawal. Turning now to other conduct of business issues, in 2016, ASIC published findings from our industry-wide thematic review of life insurance claims. Our review found that, pleasingly, overall, approximately 90% of claims that go to decision are paid in the first instance. We did, however, identify problems in specific distribution channels and with specific products. For instance, in the sale of direct life insurance, that is, policies sold without financial advice, these problems included higher rates of declined claims and higher rates of lapsed policies. We also found higher rates of declined, withdrawn, and disputed claims for total and permanent disability insurance. Another key finding from our review was about the poor quality of insurers' data. We've been doing further work on these 3 areas over the past 2 years, and we'll now touch briefly on a couple of them. So firstly, we've been collaborating with Australia's prudential regulator, APRA, to develop a public reporting regime for credible, reliable, and comparable life insurance claims data at both the aggregated industry and also insurer-specific level. This has been a challenging process due to the varied data and systems capabilities among insurers, but both ASIC and APRA believe improved claims data reporting will underpin better industry, regulatory, and consumer outcomes by driving informed consumer decision-making and healthy industry competition. In early next year, we will be publishing online claims outcomes by insurer, channel, and product type, which will increase transparency and accountability for consumers and the industry. Our further review of life insurance that is sold direct to consumers, that is without financial advice, found that too many people experience poor outcomes, often resulting from sales practices that include pressure selling or the bundling of different types of cover where consumers do not understand what they are buying or whether it meets their needs. ASIC has called on firms to address business practices that are driving poor consumer outcomes, including product design, sales scripts, and incentives. ASIC is also taking regulatory action, including enforcement action, where we have identified the most concerning conduct, We have several investigations currently underway. Using our powers to restrict outbound sales of life insurance and funeral insurance, and monitoring outcomes, including for accidental death insurance, and using current and future powers to intervene if outcomes don't improve. Turning now to a recent key initiative, ASIC has started a program of close and continuous monitoring of the largest financial institutions. This has seen ASIC teams on site at the large financial institutions for extended periods of supervision. This initiative will take a thematic approach, with breach reporting being the first area of focus. We have started with the larger banks and will move on in due course to include other large firms, including insurers. While this is a new approach for ASIC, it is something that both prudential and conduct regulators have been doing in other countries for some time, including here in Hong Kong. In addition to the work being undertaken by ASIC, the Australian government has also begun the process of legislating to significantly upgrade ASIC's penalties and powers. Some of the penalties have not been increased for more than 20 years. Criminal penalties are set to double from 5 to 10 years in some cases, and monetary penalties are also due to increase more than 10 times for corporations and more than 5 times higher for individuals. The Australian government is also finalising new laws that will introduce design and distribution obligations on firms providing financial services and a product intervention power for ASIC. This is similar to the product oversight and governance framework in Europe, and Australia's design and distribution obligations will apply to issuers or distributors of financial products and be imposed at the stage of product design and distribution, and also after the sale of the product. As a complement to these obligations, the government is also introducing a product intervention power for ASIC that would enable us to make orders for up to 18 months prohibiting specified conduct in relation to a product, or even ban a product in extreme cases, where it is identified as creating a significant risk of consumer detriment. This power would enable ASIC to take action before further harm is done to consumers. There are currently a number of areas also where insurance products are carved out of the financial services conduct regime in Australia. One such area is unfair contract terms provisions which exist in the consumer law. The government has announced plans to extend unfair contract terms provisions to insurance contracts. Another key area where insurers have been exempt from conduct obligations is insurance claims handling. The government has also indicated that it will consult on changes to the law in this area to enable ASIC to properly supervise and, when needed, take action in relation to insurers' conduct when handling insurance claims. So in conclusion, market conduct supervision is clearly a hot topic in Australia, and insurer conduct is very much in the frame for regulators, government, media, and the general public. The recent work of the IIS in strengthening ICPs 18 and 19 also shows the importance of this work globally. Insurers and intermediaries clearly need to step up in some key areas to ensure their products provide value to consumers and meet genuine consumer needs. They also need to ensure they have the systems, processes, and culture to develop suitable products, sell them appropriately to consumers, and handle consumers' claims fairly and efficiently. And we as regulators need to be clear about the standards we expect industry to meet, while remaining vigilant on behalf of consumers and ready to enforce those standards when necessary, using the most appropriate regulatory tools. That concludes my presentation. I look forward to the panel discussion. Thank you.